Hello, I'm TaxLawPaul. I have 40 years of experience as a lawyer and a CPA. This video is about year-end tax planning primarily. Let's start with business planning. With the new Tax Act, the big beautiful bill, 100% bonus depreciation is back. But there's a little quirk. For property acquired before January 20th, it's 40% bonus. Property acquired after January 19, it is 100% bonus depreciation. For tax planning purposes, it does make sense to buy assets now before the end of the year to be able to write them off 100%. When I say assets, I'm talking about tangible business personal property, not real estate. Now, you have to balance it. Do you really need that piece of property? Well, if it's in the future, or if it's in the near future, you're going to buy it. Probably a good idea to do it now. And additionally, automobiles are great tax write-offs at the end of the year. The larger automobiles get the 100% depreciation over 6,000 pounds. The ones under 6,000, they get about 20,000 depreciation you can take. Now, what you want to do is get your business percentage high. One way to do it at the year end is to plan out the year end where that automobile is 100% or close to 100% business use. Now, let's say and if you go under 50% business use, the depreciation goes way down. Your depreciation is a lot slower. But what you can do instead is you can do, in many circumstances, you do 70 cents a mile. 70 cents a mile works great if, for example, if you're self-employed and you have a modest automobile and you're driving lots of miles for business. That is an excellent deduction. For example, 20,000 business miles at 70 cents, that's a $14,000 tax deduction. So it's something to definitely be aware of. Now, there are other business planning tips also. For example, one way to do this at the year end is to defer income into 2026. For example, if you are invoicing your clients in early December, you very well can get paid in 2025. Well, slow down your invoicing. Get paid in 2026. The inverse, pay business expenses that are related to 2026 in 2025. Now this works if you're a cash basis taxpayer. You cannot pay everything in advance and your cash flow does not allow it. But paying your rent, prepaying insurance, etc., those are good year-end tax deductions. Now, another one is pension plans. If your company does not have a pension plan, setting one up prior to year-end can set it up where you take a deduction in 2025 for a payment that you make in 2026 as late as October 15th, 2026. An excellent tax deduction, good for employees, good for your retirement, a win-win for everyone. Now, there is one thing that is still alive in the tax law is the 20% business income deduction. It's a great deduction for businesses. However, some businesses do not get the full effect of it or get phased out on it. Well, these are professional businesses like accountants, lawyers, doctors, consultants, that when their income goes over a certain level, they get phased out of the 20% deduction. However, if you max your pension plans out, that brings your income down and very well drives up that business income deduction. That is something for certain professionals to be aware of. Now, here's another thing to be aware of, is tax deduction, tax basis in your S corporations and your partnerships. If you do not have sufficient tax basis at the individual level, your deduction is limited. Well, this happens if you bought a $100,000 piece of equipment at the year end and it's 100% financed, no cash out of your pocket. You take a $100,000 deduction, you might be limited and that deduction is carried forward. Well, there's certain things you can do. One is make a capital contribution to your corporation or to your partnership. And in the partnership setting, guaranteeing loans provides basis, but not in the S corporation setting. So be aware of that. Here's an excellent one coming up. Form 1099s. Starting in 2026, the law is going to be that businesses do not have to prepare 1099s unless they're over $2,500 of compensation versus the $600. It has been $600 since 1975. It is a real onerous burden for small businesses to prepare all those 1099s. But 2025, we still have that rule, and now is the time to get organized, to get your 1099s prepared, to get them out the door. Now, one thing that is happening for year-end business for 2025 for businesses is the third-party transactions where you get the 1099Ks, credit cards and certain other businesses. Well, now there's a threshold where there has to be $20,000 worth of transactions and like 200 of them, then you're subject to the 1099K reporting rules. So that is going to help small businesses out significantly. All right, now let's go on to the individual tax planning strategies. Well, in the last Tax Act, the big beautiful bill, the SALT deduction, state and local taxes. Now at the individual level, you can deduct up to $40,000 versus $10,000. So back to the strategy, in certain circumstances, pay those state and local taxes that are due typically in January 26, pay them in December 2025. Now they will yield a tax deduction, but just the first $40,000. Now, here's another thing to consider. Adjusting your W-2 wages at year end. As I mentioned previously, don't be overpaid. If you have sufficient withholdings and you're going to be overpaid, it would make sense to adjust your W-2 where you do not get withholdings in December. Or if you know you're going to be underpaid, well, ticking up your W-2 withholdings could be helpful. Consider that strategy. One of the best strategies is donating appreciated stock to charity. Example, you buy a stock that's for $5,000. It goes up to $15,000 in value. You can take a $15,000 deduction by donating the stock to the charity versus selling it, reporting a $10,000 gain, and giving your charity $15,000. An excellent strategy, especially with this stock market. It's been up 70% in the last 3 years. There are a lot of appreciated gains. Your church or your favorite charity will appreciate it. Now, there is a limitation of 30% of adjusted gross income versus 50% for cash. So watch out for that. If you make $200,000 and you give $100,000 appreciated stock to your charity, well, you're going to be limited that year, but it will carry over. Another one is charitable giving from your IRA. If you're over 70 and a half, given your making the distribution directly to your charity versus to yourself is very helpful. What it does is you don't have to report that income. Now, you don't get a deduction, but it can help lowering your adjusted gross income, which has other benefits. Now, speaking of appreciated stock, there's a lot of stocks that have been sold during 2025, and you're going to have capital gains on those. Now, take a look, work with your financial advisor or yourself. Look for those stock positions that have decreased in price and sell those and yield and take the deduction against the capital gain. Now, you can't buy it back. If you buy that position back within 30 days, that deduction does not count. However, cryptocurrency, that's a different story. You can sell a crypto asset because it's not considered stock and buy it back the next minute and harness that loss. So that's a benefit of crypto. Crypto has shot up significantly, now it's pulling back. That's a strategy to consider. Also, you want long-term capital gain. If the asset you have to hold it for at least a year and a day. If you're at 10 months and your stock has gone up in price and you're a little concerned that it has, I'm topped out, well, consider holding it 2 more months and to get the long-term capital gain. It's a balance between economics and taxation, and the clients, that's up to them. Just be aware that that exists. Back to estate planning. You can gift people up to $19,000 a year without having to file a gift tax return, without affecting your estate taxes or having to pay gift taxes. Consider that. You can give away quite a bit. A married couple, 19 times 2, that's $38,000. Have 3 children, well, you've got gifts over $100,000. And what's good about that is that it takes those assets out of your estate and puts them in the hands of perhaps the younger generations whose tax brackets are lower. Then those taxes from the dividends or interest that maybe the stock will generate, it will be taxed at a lower rate. Okay, therefore, consider gifting before the year end. But here's a good one. Payments for medical, education, directly to the university or the vocational school or the hospital or the doctor. They're not subject to any type of gift taxes or gift tax consideration. So if you're in that situation, donate directly or pay the bill directly to the institution. All right, now, the estate exemption is still high. It's going to be $15 million per person and indexed for inflation. Right now it's about $14 million, so it's going to go up next year. Keep that in mind. If you're fortunate to a married couple that has an estate of $30 million or more, it's time to consider, how am I going to save estate taxes? The gifting strategy is excellent, a good problem to have. All right, here's another thing that came out of the tax bill. That is the Trump savings account. This is a good one. If you have children or anyone born in 25 to 28, an account can be started where seed money, the first $1,000, can be paid via the parents' reducing their taxes by $1,000, and that goes into the child's account. And then people can donate up to $5,000 a year into that account, grandparents, parents, etc. Employers can even put $2,500 tax-free into that child's account. Now, it goes into that account and it grows. It grows tax deferred, subject to another limitation we'll speak about. It can grow, and then when the person takes it out for education, first business, or first home and a business, they pay capital gains rates on it. Capital gains rates can be extremely beneficial, as low as 0. And so by age 18, you got to start making some decisions. Now, and if you keep this in your account by age 30, you have to roll it over into a Roth IRA or start having to pay taxes on it, ordinary income rates, plus a 10% penalty. Nevertheless, start using, if your children are young, really be looking at these accounts. They will compete with, should I do 529 or should I do these Trump savings accounts. They're both excellent vehicles for taxes. Okay, now earlier in our discussion, we spoke about pension plans. In our newsletter, what we have here is the options for pension plans. A self-employed person can give up to $70,000 into their pension plans. Now, it depends on the type of pension plan. There's all sorts of limitations, too complex it shouldn't be this complex. But this chart helps simplify it. And take a look at that if you're thinking about donating to your pension plan or contributing to your pension plan or setting one up for your employees, etc. So what I have covered is kind of the tried and true tax planning tips for 2025. There are various others that are out there, but that is the low-hanging fruit. Please give us a call, 918-901-9000 to help you out with your taxes. Take a look at our website, paulhburgess.com. Look at our videos, Tax Law Paul. We have various videos on estate planning and finance taxes. Thank you very much.